Thanks for tuning in to the Probasco podcast. Today is January 25th, 2024, and I'm Claudia Williamson Kramer, the Probasco chair here at UTC. Today I am joined by Brandon Bolen, who is our guest speaker tonight. He is an assistant professor of economics at Mississippi College and my PhD student when we were both at Mississippi State University. So I'm very thankful and happy to have Brandon joining us, not only on the podcast, but also as a speaker tonight on UTC's campus. So, Brandon, what I would like for us to start talking about is just give us an idea of your talk for tonight. The talk's titled, Credit for Me, but Not for Thee, Small Dollar Loans and Interest Rate Caps. On one hand, that's a mouthful, and there's a lot packed in there. And so maybe if you can just start off by explaining to us, what are small dollar loans? And then how do interest rate caps kind of fit into that landscape?
Sure. Let me just say I'm happy to be here and happy to be a part of this event. And yeah, I'm happy to talk about a topic that I think is actually often misunderstood and sometimes controversial, and that is how these small dollar loan products work and whether or not they help or harm people. When I say small dollar loan products, I mean small dollar short-term credit products. So good examples of this would be a payday loan. So a payday loan is typically like a 2-week loan where a borrower borrows a few $100s and pays back. The general rule is about $15 to $20 in interest per $100 they borrow. So a $300 loan would pay back $345 or $360 over 2 weeks, and it's a lump sum payment. So payday loans a really common small dollar short-term credit product.
So let me ask a follow-up with that. Who gets a payday loan, or I guess how do you acquire it? So we hear about payday lending, but what does it actually look like? Yeah,
so I think many of us are familiar. If we drive down the highway, we see payday loan storefronts. Mm-hmm. That's pretty common. There are online payday loans.
Okay.
One of the basic requirements is to have a checking account. A lot of borrowers who use these products are deemed, are generally considered maybe not credit worthy by a lot of mainstream credit institutions. And so these products are accessible to those that maybe might not be able to receive credit from what we would consider more mainstream credit products. So people receive them in traditional brick and mortar storefront payday lenders, or they can receive these online.
So requirement would be a checking account. Is it required that you have a paycheck? So is it like a loan against your own income?
It is. It is it's a loan against your own future income, and yes, so they assess the borrower's ability to repay, and they extend these loans to these borrowers, and the idea is the next pay cycle, 2 weeks later or so, that the borrower would repay.
Okay, that's right. That's great. Yes. That's helps to clarify.
Yeah,
because I agree. I think there's a lot of misunderstanding in this space.
Yes, that's correct. And these are products that only a minority of Americans are using. Most Americans are not using these products, but for those people that are using them, they are important sources of credit when they have few other options. The people who are using these products, a lot of times have very few credit options or are in difficult financial circumstances. And so these products can help them in difficult times. And, for example, a common use might be to pay a utility bill. And, if an individual is in a position where they're facing not being able to pay their light bill and having late fees or their utilities disconnected versus a payday loan, none of those are great financial options. We don't wish that financial situation on anybody, but the payday loan in some cases may be the least bad option, is one way to say it. It may be the cheapest option in some cases, and a lot of us who don't use those products often, we really probably don't have a complete understanding of what type of situation the common users are in and what their other alternatives are, and whether or not the payday loan is the cheaper alternative for them.
So payday lending, so what else would count as small dollar lending?
Yeah, another common form of small dollar lending is pawnbroking, so pawn loan. So with a pawn loan, you take in an item to a pawnbroker, and it could be electronics or jewelry, and the pawnbroker will assess its value. One pawnbroker told me one time that he looks on eBay to see what that item is selling for. So you bring in your Xbox and you're pawning it. He finds on eBay that Xbox sells for $160. So he'll loan you $80 or something on the Xbox. And if you repay the loan with interest, you get your Xbox back. If you don't, the Xbox is now the pawnbroker's. You also have the option to pay the interest only and to renew the loan, kind of roll it over.
Okay.
But if you default on this loan, then the pawned item becomes the pawnbroker's to sell and recover the money he loaned out.
Okay.
So pawn would be another example. Vehicle title lending, which is actually a form of pawnbroking in a sense. You kind of pawn the title to your vehicle, so you actually maintain possession of your own vehicle, but the lender holds the title to your vehicle. And if you don't repay the loan, then they can repossess the vehicle.
Okay.
So it's actually similar to pawnbroking. And then another common product is what we call a personal finance loan or an unsecured installment loan, which is just no collateral. You use the proceeds in any way you choose. Those loans can be a little larger than a payday or pawn loan, but still a relatively small dollar credit product short term.
So what is the range in terms of small dollar lending? Like when we say that, what is the amount that you're typically thinking of?
Yeah, I typically have in mind. So a payday loan, you're talking about a few $100s generally, and there's a range there. Pawn loans are similar. The unsecured installment loan, the vehicle title loan, those can be larger. And some people are using those personal finance loans who are what we would consider credit worthy at other mainstream institutions, and they're getting relatively large unsecured installment loans. So those personal finance companies are making loans not just to what we would call like a subprime borrower borrowing a small amount of money. They're also making loans to borrowers that we call a prime borrower, high credit score individuals who just like the convenient access to money and are borrowing actually relatively reasonable sized loans. So
$1,000, $2,000,
$20,000. I mean,
okay.
large loan amounts. But when you're talking about when I'm talking about small dollar short term credit products, I'm generally talking about the personal finance loans kind of on the lower end.
Okay.
So the 500 credit score individual who needs $800 to pay rent.
Okay.
So that's that in that sense, the personal finance loan overlaps with these other small dollar products like a payday loan. But there are individuals that do use those products for much larger amounts. So
yeah, that's really interesting. Okay, so we've kind of at least given more of a background and given an understanding of what we mean by small dollar lending or the small dollar space. So the other part of this story is interest rate caps. So kind of it's a price control. And so, something that in Econ 101, we basically will go over pretty quickly or within the semester. But we don't always talk about interest rate caps as being one of those. We may talk about minimum wage or rent control as being an example of price controls. And I've also often found, and you and I were talking about this earlier, that when we kind of switch that to, okay, maybe we wouldn't want to control rent, for example, but controlling interest, that as if that operates differently. So maybe just, start going over the interest rate caps and what you're going to talk about and how that relates to small dollar loans.
yeah, that's right. So the interest rate is just the price of money. That's what I would tell principals of economics students in a classroom. I would say the price of money has a special name. We call it interest rate. But it's no different than any other type of price ceiling. When you put a price ceiling on a product we teach in Economics 101, you end up with a shortage of that product where the interest rate caps are an example of that. Traditionally they've been called usury laws. These are not new ideas. This go back to the Mosaic Law for ancient Israel. This goes back to ancient Babylon. The earliest known forms of credit had interest rate caps, and so this is not a new idea. These have been around for a long time, but when just like we would teach our students, when you restrict the price, you end up with individuals who are no longer served by that in that market. Really one of the things the way we restrict the price for these products is often by capping what's called the APR, the annual percentage rate.
Okay.
So, for example, the Military Lending Act of 2006 caps APR for military service members at 36%. And that's because the Department of Defense said that these predatory lenders were targeting service members and it was compromising military readiness. And so that, around a military base, you might see payday lenders and so forth. And so they were concerned about their service members getting these expensive forms of credit. The Military Lending Act capped interest rates capped APR at 36%. And other states have done something similar. Illinois in 2001 passed a 36% APR cap. And that was applicable to all all people in the state of Illinois. And so it wasn't just the military service members, but all people. So basically, when we pass these, when I say an interest rate cap, what they're using is what's called the APR of a loan, the price of that credit. And what I think many people misunderstand about these products is exactly, I guess what I believe is that people have sticker shock when they see the APR on these products. So a common APR on a payday loan might be 300, 400, 500% APR. And what we do when we hear that number is we compare it to credit products that we're familiar with. Our mortgage, which is a 6% APR loan. But our mortgage is a 30-year loan or a 15-year loan. A payday loan is a 2-week loan.
Right.
And by requiring a payday lender to report an annual percentage rate, what we're doing is requiring them to take a 2-week loan and annualize it as if the borrower did this every 2-week cycle for a year, what would be the total interest they would pay. So a 2-week loan, you borrow $300, you pay back $60 in interest as a 520% APR. I think a lot of us would, if we heard the numbers in dollars, I borrow $300, I pay back $360. That doesn't sound as harsh as 520% APR. And that's because I think a lot of us hear that APR and we're drawing inappropriate comparisons to longer term credit products with higher principal amounts.
Yeah, that definitely, it sounds a lot different when you put it in absolute dollar terms versus a percent, and a percent that is not necessarily relevant for the comparison, as you were saying.
Yeah, that's right. And if you think about the decisions that a lot of these users are facing, they're not comparing using a payday loan to a mortgage. I mean, obviously, there's very distinct credit products. They're comparing, I can't pay my utility bill this month. And if I don't pay my utility bill, I'll have a late fee. It might get disconnected. I might have a reconnection fee. And so the comparison is not actually another credit product reporting an APR. The comparison is a fee if I miss my bill. Or if I don't pay my rent, I pay my landlord a late fee. So the borrowers are actually not using the APR in a lot of their decision-making process, which is appropriate because there are alternatives are not typically other mainstream credit products. Many of them are not credit worthy for other credit, or considered not credit worthy by mainstream credit lenders, or they've maxed out the use of their credit card or something like that.
Right.
And so they don't have access to cheaper forms of credit. So the real alternative is not some other credit product. It is actually a fee. And so when they look at when these borrowers focus on the dollar cost of these loans, that's the appropriate thing to focus on in many cases, because that's what their alternatives, that's the way their alternatives are priced, in dollars, not in the APRs.
I think that helps us to be a little bit more compassionate toward people who may be using this, and that, that's not, their options are not the same as my options, or the relative alternative is not exactly what I would be facing. And I think a good example, a similar story that you've kind of outlined in research papers or other times I've seen you present, is it may be, if you don't pay your utility bill, then you're going to have to pay a reconnection fee that's higher. But also in the interim, if your electricity is turned off, there are real costs there.
That's right.
And some of that could be you lose the items in your refrigerator. Well, how much is that worth? That's probably worth more than $40 or $60. And, let alone the inconvenience and the headache and, the other things that would come along with trying to just deal with not having electricity for a day or 2 days before the company could come back and turn your electricity on. So I think that is also, when you start to put it in real terms of these are the situations that people can find themselves in, and these are their alternatives. Right. And so I think that helps to humanize it a little bit. And then also, we always talk in terms of opportunity cost. And so that's the relevant cost, like you said, not comparing it to your mortgage, which doesn't even make sense in this situation.
That's right. And that, that highlights that we really don't know the alternatives of these individuals that are using these products. And I think, an assumption that some people make is, a 520% APR loan, how can that possibly be good for somebody? But I think we misunderstand what that actually means. Like I said earlier, the APR is a little deceiving on a 2-week loan. An annual percentage rate on a 2-week loan is deceiving. But also, I think we overestimate our own ability to know what those individuals are facing financially, and we probably underestimate their ability to make good decisions for themselves.
Yeah, that's interesting.
And so we really, like you said, there are costs that people face. If I miss my utility payment, it's not just the reconnection fee might be more expensive in dollar terms in a payday loan. That's possible, but also if I go without utilities, what is that costing me? Not just in, if I lose my groceries in my refrigerator, but also like just the inconvenience.
Yeah.
There's some cost being imposed on people. And, when non-users of these products, which is the vast majority of Americans, see the APRs on these products, and they see these lenders locating in lower income neighborhoods, and they see I think I think a lot of times they're just not they're assuming that these individuals who are using them must be making a mistake. Instead of giving those individuals the benefit of the doubt that those individuals know their own financial situations, their own financial options better than some outside party would know.
Right. Yeah, I think that, again, that's an excellent point. I think the economic way of thinking actually should make us a little bit more cautious when we're trying to judge other people's situations, right?
That's right.
We base subjective value. All costs and benefits are subjective. So in this case, I don't know your relevant cost and benefits of using a small dollar loan, for example. And I think at least economics makes us pause and reminds us of that. And I think that's what your research is showing, which is fascinating. So from there, what is, kind of a few takeaways that you hope to convey tonight? We've already discussed some of them in terms of just getting people to understand the, relative alternatives, and that's really the way to start thinking about these products. But are there a couple other takeaways that you hope that people walk away with after attending the lecture tonight?
Yeah, I think the reason it's important we understand these products is not because, like I said, many of us do not use these products. And I want to be clear, these are expensive forms of credit. For those of us who have access to mainstream forms of credit or other alternatives, these are not financial products that I would recommend to somebody with better options. But the reason it's important that we understand it is because we spend a lot of time. The state of Illinois, as I mentioned, in 2021 passed an interest rate cap of 36%. The state of Washington is currently considering one. The state of South Carolina was recently considering one. There are numerous states that already have, or many states have interest rate caps of some form, but this specific Military Lending Act cap at 36%, all in APR, is being taken up by a lot of state legislatures, and the way that politicians feel about it, the way we as voters feel about it, it matters because we need to understand the consequences. If we cap interest rates at 36%, we're removing credit options from individuals who already have very few credit options. And like I said, some of this, the importance of just understanding these products is really so that we don't remove options that may be good options for many individuals. Now, are there people out there that make financial mistakes with these products? Yes. Are there people in difficult financial situations using these products? And in some cases, is it worsening their situation? Yes, that happens. But the research and the survey data seems to indicate that the vast majority of the users of these products understand the products. They understand their own likely repayment behavior. They understand their alternatives, and that they're going into these credit decisions with their eyes open. And I just I think we need to be cautious about removing options from people whose financial situations we don't always fully understand.
I think that it reminded me of just a point in any time that we're talking about trying to control price, to really what people want is that there's not people out there, at least this is how I would think of it, people who are arguing that this is predatory lending and we need to eliminate that as an option, is what that they're really hoping for is that people don't demand this product. Mm-hmm. But the problem, whenever you make something illegal, the demand is still there. You're just changing the supply. Who's going to supply this product? And you're changing the price of that, and you're going to change the form in which it's going to take. And so I if we just think about prohibition in this country, the 1920s and 30s, in terms of what did that look like? And it's not that people stopped drinking alcohol. It's just where they got it from and the type of alcohol. And, you didn't know what you were necessarily getting. So when you shove people into more of an illegal space to consume a product, it tends to have a lot of unintended consequences. And I just think that also is an important reminder for people who are thinking about, well, of course, this is, awful or this product is predatory. Like, well, what does that mean? But furthermore, if you remove it and they still need $300 to pay their utility bill, where are they going to go to next?
Yes, that's right. And as you mentioned, regulating away these products, whether that be through an interest rate cap or some other form of regulation, doesn't solve the problem that people are in financial circumstances that have urgent needs for cash. And, we've all heard the term loan shark, that a loan shark is an illegal lender who's lending, at typically higher rates than the law would allow. That we know that term for a reason, because interest rate caps push borrowers to often illegal lenders and so forth. And I think it's important for us to consider the consequences, whether intended or unintended, of our choices in regulating these products. And let me mention something about that. I mentioned the consequences, intended or unintended. I think, like we mentioned at the beginning of this discussion, we teach our students as early as principles of economics that when you cap a price, that there are going to be people who are still have demand for that product that can't find somebody to provide for those credit needs. And that's true for price ceilings in general. And I don't think that's lost on a lot of people who support these caps. And what I mean by that is, I don't think some of the people advocating for these interest rate caps are naive about that. I think they think that's in some cases, some people are naive and they don't realize, I'm trying to protect these borrowers, and what I'm really doing is robbing them of credit opportunities. It's not that they get cheaper credits, that they get no credit. Some people are naive, but some people are quite aware that they're going to lose credit options. They just don't think borrowers are making good enough financial decisions for themselves. So they're very intentional that, that's precisely the point. We want them to lose credit options because they shouldn't be using that product. And that's just a different way of thinking about it. I don't think it's so much, sometimes we see people lose credit options and we think, well, that must have been an unintended consequence. The state of Illinois passed a 36% cap. I have some recent research that shows that subprime borrowers lost as much as 40% of the number of unsecured installment loans they were previously receiving. And you look at that result and you think, I wonder, this is probably an unintended consequence of some of those legislators who voted for this. But for some of them, it's actually an intended consequence in the sense of, we actually wanted them to lose access to that product because we thought that product's dangerous and we don't trust them to make financial decisions for themselves. So it's really a difference in worldview in a sense of, do I trust these individuals to make those decisions or not? And in some cases, we're legislating these products away intentionally because we just don't think these products should be available. Whether you believe they're good for you or not, we're telling you they're not good for you.
So it's much more of a paternalistic perspective.
That's right.
Using public policy to take options away from people. That is exactly the point. Yep. So do you have any sense from that where they think they're going to go for credit? Like, it's not if I don't use payday, I then go to the regular bank, right? Mm-hmm. So is there any next, forward thinking of, I'm going to eliminate this as an option because I don't think they understand the product and it's bad for them? So again, more paternalistic, but then the credit need is still there. So have you ever had discussions with maybe some of the legislators or people who are working in this public policy space of, well, then what?
Yeah. I really don't know the answer to that question. I don't know exactly what their expectation is for these people. I frankly, I think a lot of times they think these people just need to be a little more financially prudent. They're obviously they're in a difficult financial situation. Maybe it's some financial actions that they're taking that's putting themselves in difficult financial situations, and they just need to tighten their belt a little bit.
Yeah.
And so
okay.
That's but I really don't have a good sense as to what people are expecting these individuals to do when you're regulating away the few credit products that are granting credit to individuals with credit scores below 600, below 500.
So with that, do you have a sense of, and in talking with you and your co-authors and others that work in this space, so most of the people using these products don't have access to traditional banks, traditional lenders. And so is it mainly because they are in a situation of having a lower credit score? Is that, that we call them subprime borrowers? So is that traditionally, or I guess on average, what we're seeing? And then from that is, Well, then why don't traditional banks find it worthwhile to lend small dollar amounts? Do you have any sense in terms of trying to understand, like, why do we have a kind of specialized, unique product instead of, well, okay, I have a checking account. Why can't I go to my bank to get the $300?
Yeah, I think there's a mix of things going on. There are borrowers who are not deemed credit worthy, so they don't have access to mainstream credit products. But there's also many borrowers who've just maxed out the use of their credit card and their other credit products,
Okay.
and they've exhausted their mainstream credit. So they
Okay.
do have access to mainstream credit, but they've just exhausted the use of that. For both of those reasons, it pushes individuals into these alternative credit, these alternative lenders who are willing to further extend credit at higher rates. And what was the second part of your question? I'm sorry.
Well, I kind of mixed it with kind of the type of user. Why is it they're deemed? So you've said several times they're deemed not credit worthy. So I think you indirectly answered that just in terms of whether I said it wasn't mainly their credit score, but if they are able to get access to, say, a line of credit at a traditional bank and maybe they've exhausted that, but they still find themselves in need of credit. And the traditional lenders won't extend more, but these non-traditional lenders might, but at a higher rate. And so maybe expand on that a little bit. Why is it at a higher rate? Why is that necessary in a sense?
Yeah, I think, it's at a higher rate for several reasons. One, because there's additional risk. These borrowers have already exhausted that their mainstream credit options. They've in a lot of cases shown themselves to be a higher credit risk than many other borrowers. But a lot of times, I think one of the misunderstandings I run across most often in this product is, well, yeah, the rates have to be really high because those types of borrowers are going to default often. Mm-hmm. But that may be true that these products have higher default rates. But really, the driver of the higher rate is that they're borrowing $300 and the fixed cost of the lender to loan $300. So it's not that if a payday lender loans you $300 that there's some risk you might not pay back. It's that even if you do pay back, they only made $45.
Yeah. Okay. Yeah.
And so they have the fixed cost of they had to originate the loan, they have to run the storefront, they have to service the loan and so forth. And so it's really the driver of the high rate is not just the credit worthiness of these individuals, but it's that they're borrowing very low loan amounts. Thomas Sowell famously compares it, a small dollar lender, short-term lender, reporting an APR to a hotel reporting an annual rate instead of a nightly rate. And that's one of the things I want to talk about tonight. When I made plans to come to Chattanooga, I pulled up the options for hotels. There's a historic hotel in downtown Chattanooga called the Reed House, $209 a night. That seems like a reasonable price. It's a great hotel. But if you annualize that price, that's over $76,000 a year. And I can do basic math. So if they had to advertise $76,000 a year, I know I'm not staying a year. I'm staying one night, so I could back into the $209 a night. But what's happening is what could happen and what does happen, I think, in small dollar credit products is that if I can take that annual price and start drawing inappropriate comparisons. So I pulled up on Zillow, what can I rent a house for in Chattanooga? And there's quite a nice, I can't give you the address here off Zillow, but there's quite a nice rental house available to me over 3,000 square feet for only $38,000 a year. That's half the price of the Reed House per year. And, but the point is those two things aren't directly comparable. Why not? Because the Reed House is a one-night stay, a two-night stay, or a week stay, or whatever, and there are fixed costs associated with that. They have to staff the front desk to check me in, check me out, to clean behind me, and so forth. And there's, that to run the webpage to allow me to book and so forth. The fixed costs are high, per night stay, and so they charge $209 a night, which is reasonable because they have to cover all those costs. It's not just I'm not just renting real estate, but they got to pay for all the fixed costs that are associated with that. Whereas the rental house spreads those fixed costs thinner because they're renting it out for a year or 2 years at a time. And so you really can't compare a short-term stay, and we don't because we understand how hotels work. We understand the difference between a hotel and a rental property. But you really can't compare these two things. But that's precisely what we do a lot of times in credit products. And so we say, well, the 2-week payday loan, 520% APR, we compare that to some long-term credit product as if they're the same thing. And we don't realize that payday lender, and this is really what drives the high rate, is that payday lender has fixed costs that need to be covered on a very small short-term loan. And So even if, as you mentioned, do these borrowers default at a higher rate? That's likely true. But even if they all repay, I'm still a $300 loan. I'm still only making $45 or $60 interest, and I have fixed costs that need to be covered.
Right.
So the driver of the higher rate there is actually the high fixed cost relative to loan amount. Just the same way that a hotel is priced differently than a long-term rental property. It's because they have those high fixed cost of these really short temporary stays.
Yeah, I think that helps to clarify and make sense. So any other takeaways? I know that you'd mentioned your Illinois paper, which was fascinating, recently published. But any other, thoughts that you want to convey in terms of just trying to get people to kind of understand what's happening in this space? And then again, with when we hear advocacy and promotion of interest rate caps, how do you want people to start thinking about it?
Yeah, I think it's important to listen to what these borrowers are saying. I mean, and not all of us are spending time reading the academic research, looking at survey results, but we have survey data from individuals in Illinois taken 9 months after the interest rate cap was put in place, and these individuals were surveyed from institutions that had left Illinois. So these were lenders that were previously lending in Illinois, had previously lent to these customers, and then these institutions left Illinois as a result of the cap.
Okay.
And then we have survey data from these borrowers, and we asked them simple questions. Did the loan you received previously help improve your financial situation? Vast majority, 90+%, say yes. Would you like the option to return to your previous lender? Vast majority, yes. What types of circumstances have you faced since you lost access to your lender? I'm paying bills late. I'm generating fees. My utilities got cut off. There's all kind of options they could select there. I had to go to a pawnbroker. Had to go to friends and family. My kids were impacted negatively. Really, clear that these individuals losing these credit options would really like to have those options back. And so I think there's a lot of us who, again, don't use these credit products, who are seeing this legislation passed and don't do a good job of putting ourselves in these individual shoes and trusting them to make good financial decisions for themselves. And I think we need to do a better job listening and putting ourselves in their situations and considering their financial alternatives, and considering that a lot of us either voting for this legislation, passing this legislation, or supporting politicians who do are not users of these products and don't understand these individuals' situations and their alternatives. And we shouldn't make assumptions that we do. And so, I see that in the Illinois results from the study you mentioned, where these individuals lost credit access and overwhelmingly responded that they would like access to their previous lender. And we see that that's consistent across the literature. When you see the survey results of, would you be willing to use this product again? When you ask these individuals after they've used a pawn product or payday product or vehicle title, and one result I'm thinking about, 30-40%, I can't remember the exact number off the top of my head, said, yeah, I'd love to use it again. Another large portion, 30-40%, said, well, I'll use it if I have no better options, which I think is a perfectly great response. It's like, yeah, that's the way you should think about it. Of course, if you had better options, you should use something else. And very few individuals are saying, no, I would never use that product again. And,
that's interesting.
And so I think that the users of these products and overwhelmingly, say that they would use them again. It does not mean that individuals don't get in difficult financial circumstances with these products, or that some individuals don't make bad financial choices with these products. Roll over a payday loan, for example, over and over again and pay back just tremendous amounts of interest. That happens to a minority of these individuals. But what we're doing is we're legislating these products away through interest rate caps to protect those people who are using them recklessly at the expense of the majority of people who are using them and saying that they really benefited from their use.
Yeah, that survey is really fascinating. So a couple things came to mind when you were talking. So there's been a recent proposal, and I think some press coverage based on your research, where there's the idea of doing some sort of 36% interest rate caps on credit card legislation. Is that right?
Yeah.
Okay, so I'm pretty sure that it's been proposed. I don't know if it's gotten anywhere. And so that's now shifting a little bit away from just, again, this, I think, minority of people who would need to use a payday loan. I mean, most people use credit cards, even people who pay their bill every month. Most of us are using a debit or a credit card. And I would say, a large majority of people just use a credit card. I use it for no other reason to accumulate points. And so just in thinking that through, like, how would you relate the results that you found in your Illinois paper and then your other research in terms of just kind of getting familiar with the small dollar lending, and when we try to kind of regulate them out of business, how would a 36% interest rate cap affect, if it applied to credit cards, for example?
Yeah, I think, for a lot of products, including credit cards, a 36% cap is going to have very little effect in the sense that it's not binding. The APRs are not going to be above that. But we are in a rising rate environment currently, and that's unique. It's been, we're in a unique rate environment in the last few years. And so that's one of the things we could see is if we continue to see increasing rates where these caps become binding on more mainstream credit products, that's a possibility. So that there is some possibility that could have some effect, and how, exactly what that might look like, I'm not sure.
Yeah.
Could that be they cut things like the rewards that you receive and so forth?
Yeah, that's what I was worried about.
Yeah, that's right. No more airline miles, or at least fewer airline miles. I don't know. I can't say exactly how that will play out, but like anything, a binding rate cap in this case would limit credit availability.
Yeah, I found that interesting and fascinating. And one of the things that comes out of all of this, when you start kind of reading the literature, and most of it is at 36%. And is that just an arbitrary number? Like, where did that come from?
Yeah, I think that number's been around a long time. I think the recent popularity of that number goes back a lot to the Military Lending Act.
Oh, okay.
So the rate cap in Illinois, was an extension of the Military Lending Act essentially to all Illinoisans. So I think a lot of it is tied to the popularity and the recency of the Military Lending Act. But I think 36% has been around a long time, since the early 20th century. That number's been around since the Uniform Small Dollar Law of the early 20th century. Okay. And how that number was originally determined, to my recollection, based on what it cost to originate loans in the early 20th century. They were trying to eradicate the loan sharking industry, and they were trying to come up with they were trying to create a legal and regulated lending industry to put these illegal loan sharks out of business. And they were trying to determine how much interest does a lender need to make to be able to put the lenders at that time, these loan sharks, out of business and have a legitimate lending industry. And so that was the Uniform Small Loan Act of, I may be saying that wrong, but that was of the early 20th century. And that's, I believe, the genesis of some of the 36%.
That's really fascinating. That, like, there just does seem to be this number, and that anything below that number is okay. But then once we go above 36%, and I have thought, like, why is that the number? But that's really, really interesting, giving a little bit of the background. So one other question I thought of when you were talking, and especially when you were mentioning that some of the point of the legislation or regulation around lending is precisely to eliminate someone's option, because the view is, well, maybe they just need to change their behavior. And so with that, if that, and you've even mentioned, it's not that you're advocating for these products. You're not saying, hey, go to the payday lender when next time you need $300. It's more of comparing the relative alternatives. But do you have a sense, or have you thought about, how do you prevent somebody from getting in that situation in the first place? So what is it? So again, in economics, we're value free, but at the same time, we also do hope that our research has improved the world. And so when we think about that, so your research is fascinating. It highlights these unintended consequences. It's taking away people's options that are in a bad situation. But is there something in terms of, kind of long run ways that we can, things that we can do that's not about regulating a product out of business, but more of on the demand side, that they don't need the product to begin with?
Yeah, I think that's a question economists have been asking a long time, and that we have some insight into. And ideally, I think all of us would agree that we'd like to see these difficult financial circumstances eradicated. We'd like to see people grow in prosperity so that these types of products are no longer needed, not because we're regulating them out of existence, but because people are growing in prosperity in such a way that they don't need a few $100s to cover a utility bill or to pay a rent payment. And yeah, I think there's a lot to learn. There's a lot that we know from the research and economic development and so forth about how our institutions in our society, economic institutions, about which is kind of the rules of the game of our society that structure our incentives, how those institutions affect long run economic progress. So, things like liberalization of trade and the freedom of exchange and private property right protection and the rule of law. I mean, these are big issues that affect long-term economic progress, and that's not something that necessarily it's going to eradicate the payday lending, the need for a payday loan next week. Right. But we do want to continue to see our society march towards economic progress, a society full of innovation, a culture that encourages innovation, entrepreneurship. We honor it, and we recognize that and are excited to see other people innovating, succeeding, free exchange of individuals, free exchange of ideas. So I think just a general, there's a lot of lessons I think that we can learn from economics about what causes long run prosperity. That comes down to cultures that honor and reward entrepreneurship, innovation, and so forth, and economic institutions that incentivize those things, like private property rights, the rule of law, and so forth, that create an environment that fosters economic progress, that give people the freedom to innovate and to try and to make profits and losses and succeed and fail, and over time we end up with a mix of products that we didn't know we wanted necessarily 20 years ago, but we get new products all the time and new innovations that make our lives better and make other people's lives better. And I think the more of that we have, then we'd love to see where increased prosperity, not just here but around the world, eradicates the need for these type of credit products, or at least the financial circumstances that generate the demand for it.
Yeah, it's a optimistic answer, which is always a good note to end on. And I'll just add to that briefly that oftentimes we can look at different business and labor market regulations as handcuffing opportunities for individuals to bring themselves out of poverty. And so those things do go hand in hand. So the big picture institutions of private property, rule of law, free trade, but then specific state or even local policy that it's actually, quite expensive to start a business, or it's quite expensive to hire labor. And so then you don't see as much of that activity happening. And so individuals don't have as many opportunities in terms of work or to be entrepreneurial. And one example of that is occupational licensing. And I think that that's an area in which Tennessee's does relatively well in relative to other states in terms of not having onerous occupational licensing, but we see that handicaps people from starting their own business. One of the famous examples when I think both you and I were in Mississippi was the hair braiding example of where the amount of regulation and the cost to become a licensed hair braider, because they wanted them to go to cosmetology school and they ended up arresting a lady and it got a lot of press. And it's like, why are we preventing someone from working? And that's what occupational licensing essentially is doing. That's just an example within kind of labor market regulation. But I think people who I would argue and push people to consider that they don't want payday lenders to exist is, okay, well, you've got to open up labor markets and make it easier for them to find a job. So if you don't want them to be in that situation, there's got to be other policies that potentially you roll back so that you can give them more opportunities to rise out of poverty or rise out of the financial situation that they're currently in.
That's right. And to incentivize innovation even in the lending space, the small dollar lending space.
Great example.
More accessible, affordable credit options. I'm not here to advocate for any particular credit option or industry. I'm here to advocate for the freedom of choice of individuals, that they generally make good choices for themselves. And when, one of the ways we restrict their choices is by regulating these industries so tightly that we get no innovation. We know that the forces of profit motive and competition will, if those payday lenders are charging rates that are well above marginal costs, we would think, unless there's some barrier to entry, which licensing law would be one example, unless there's some barrier to entry, we would think competition and profit motive is going to force other enterprising people that think they can offer credit at a lower price to jump into those spaces. And we want to create an environment, where not just we're creating jobs and opportunities for people so they don't need this type of credit, but also create an environment where this type of credit's offered more conveniently, more cheaply, and so forth, if it's profitable to do that.
Yeah, great point. Well, thank you for your time, Brandon. We'll look forward to the talk tonight, and you've been listening to the Probasco podcast. Thank you.